Welcome, curious minds. Today, we're diving deep into TBO Tek Ltd's first quarter financial results. This is for fiscal year 2026, the quarter ending June 30, 2025.
That's right.
You've shared a whole stack of fascinating documents with us: financials, auditor reports, the shareholder letter, press releases, everything.
Yep, the full picture.
And our mission today really is to solve this central mystery. How did a major player in global travel distribution, TBO Tek, seem to thrive, or at least show real resilience, during a quarter hit by some pretty significant global challenges?
Exactly. What strategies were at play? What do these numbers really tell us?
Let's unpack this.
Yeah, what's compelling is seeing how they navigated these headwinds. We'll look at their resilience, those strategic shifts, and how it all added up financially. And just for context for everyone listening, we'll mostly be using Indian rupees. 1 crore is 10 million rupees, which is roughly 1.2 million US dollars right now.
Okay, so let's start with the big picture then. TBO Tek reported pretty impressive revenue growth, right? But then some other key metrics paint a slightly different, maybe more nuanced story. Can you help us kind of reconcile these numbers? What's this mixed picture telling us about Q1?
Well, the main takeaway, I think, is resilience. Definitely resilience. For Q1 FY26, their consolidated revenue from operations was 511 crore.
Okay.
That's a solid 22% jump year over year from 418 crore. Gross profit looked good too, up 19% year over year, reaching 333 crore.
Still strong growth there.
Yes, but here's the nuance you mentioned. Adjusted EBITDA, that's earnings before interest, taxes, depreciation, amortization, basically core operational profit.
Right.
That stayed flat. 85 crore, 0% growth year over year.
Flat EBITDA. Okay.
But interestingly, profit after tax paid did nudge up by 3.4% year over year. So 63 crore compared to you use 1 crore last year. That flat EBITDA is definitely something we need to dig into.
Yeah, that revenue growth is impressive, especially considering, well, the circumstances. What exactly were these significant macro headwinds you kept mentioning? How do they actually hit travel demand?
Yeah, the shareholder letter really detailed it. Multiple disruptions. In India, you had the Pahalgam incident, then India-Pakistan border issues closing airspace.
Right, I remember that.
And then, tragically, the Air India crash in June. They said it created a temporary fear psychosis, really hit discretionary flying within India.
Understandable.
And then, on top of that, the Israel-Iran conflict, that caused major ripples in the Middle East, Africa, and Europe markets, cancellations, airspace restrictions, just generally suppressed travel over there.
Wow, okay, so pressure from multiple directions.
Exactly.
Yeah.
It really shows how these global events can just cascade through, even for a diversified company, which, begs the question. How did they manage any growth with all that going on?
Good question. So given all that pressure, how did their gross transaction value, the GTV, the total value of bookings, how did that hold up? Did the headwinds show more there?
Well, the total GTV for the quarter was 8,119 crore. That was up about 2% year over year from 7,940 crore.
Only 2% growth, so much lower than revenue growth.
Yeah, the percentage looks modest, right? But
Right.
honestly, given the quarter they had, any growth there reflects, I think, some pretty remarkable underlying strength. The headwinds definitely muted GTV growth.
Yeah.
But the fact it didn't shrink, that points to their broad product offering and, their geographical spread. It makes them less vulnerable to just one region or product taking a hit. Others can sort of absorb the shock.
Okay, so it sounds like a really tough quarter, but they clearly found ways to navigate it. Beyond just being diversified, the documents hint pretty strongly at a big strategic shift happening inside the business. Can you shed some light on that? What's the shift, and why is it so crucial for them, especially thinking about that flat EBITDA we talked about?
Yeah, this is, I think, the most important insight from these results. It's quite remarkable. They're not just surviving. They're actively reshaping where their profits come from. The hotels plus ancillary segment, its saliency, its importance just kept growing across all their major markets.
That's hotels and ancillaries.
Okay. This segment now makes up 62.3% of their total GTV for the quarter. That's up from 56.6% same time last year.
It's a big slice.
But here's the real kicker, that segment. It contributed a massive 84.4% of the company's entire gross profit for the quarter.
Whoa, 84%.
Yeah.
From just over 60% of GTV.
Exactly. It's not just growth. It's like a fundamental recalibration towards these high-margin services. And that provides a really strong buffer against those macro headwinds we were just discussing.
That's a seriously disproportionate contribution. I mean, it's clearly a strength, but does relying so heavily on one segment, even a profitable one, introduce maybe new risks or vulnerabilities we should think about? And practically, why is it so much more profitable than booking flights?
That's a fair point about concentration risk, though diversification within that segment helps. But the profitability, it really boils down to take rates.
Ah, the take rate.
Yeah.
The percentage they keep.
Precisely. For hotels plus ancillaries in Q1, the take rate was 8.4%. That's up nicely from 7.1% in Q1 last year.
Okay, 8.4%.
Now, compare that to the airlines business. Their take rate was just 2.6%.
That difference.
Huge difference. And that higher margin profile is exactly why they're deliberately pushing the GTV mix towards hotels and ancillaries. It's a conscious strategy, and you see it in the overall numbers. The blended take rate for all of TBO Tek hit 6.30% this quarter.
Up from what it was.
Up from 5.27% in Q1 last year,
Yeah.
directly driven by this product mix shift. And even the gross profit margin within hotels and ancillaries improved 5.56% now versus 5.06% last year.
Okay, so as they lean into this higher margin business, how's that playing out geographically? Are some regions leading the way more than others in adopting this?
Absolutely. Geographically, Europe is still their biggest source market for hotels plus ancillaries. Delivered 1,773 crore in GTV. Impressively, that was up 9% year over year, even with the Israel-Iran conflict impact.
Still growing despite that.
Wow. Yeah, but the real engines of growth here were MEA, Middle East, and Africa up 25% year over year to 1,299 crore. And APAC, Asia Pacific, was the fastest grower, up 35% year over year, hitting 415 crore.
Okay, strong growth there. What about India?
Even India, which had all those domestic disruptions we mentioned, showed resilience. Its hotels plus ancillaries business grew 4% year over year to 713 crore. And importantly, its saliency within India's total GTV increased to 20% from 17% last year. So the strategy is definitely taking hold everywhere.
Were there any regions where this high-margin hotels and ancillaries business saw a bit of a dip?
Just one, actually. Latin America, LATAM. It saw a small year-over-year GTV decline in hotels plus ancillaries, down 2% to 477 crore.
Any specific reason for that?
Yeah, they pointed to a sharp hike in Brazil's IOF tax. That's a tax on financial operations, specifically international payments. It jumped from less than 1% or so to 3.5% of the transaction value back in late May.
Okay.
So that directly made prepaid international travel bookings more expensive for Brazilian travelers and agents. Explains the slight slowdown there.
Okay, so beyond this really key product mix shift, what other strategic things are they doing to fuel growth? Especially thinking about bringing in new business, expanding their reach. How are they planning for future growth while managing today's issues?
That's a great question. It gets into their forward planning. TBO Tek's been pretty aggressive on market expansion. They've made significant investments in their sales teams, trying to boost sales efficiency starting back in February 2025.
And are they seeing results from that yet?
They mentioned seeing early green shoots, and here's a number for you. Sales driven by new agents, the ones they brought on board this fiscal year, FY26, were up 132%.
Wow, 132%.
Yeah.
Compared to new agent sales last year.
Exactly, compared to sales from new agents in Q1 of FY25.
Yeah.
So a huge jump. They expect the full revenue impact from all these investments to really start kicking in by Q4 of this fiscal year.
That's quite a leap in new agent sales. What's the plan to keep that going, to make sure these investments really pay off long term?
Well, they said they've done about 2/3 of their planned extra hiring by the end of Q1. The rest should be done by the end of Q2.
Okay.
And what's important strategically is they expect the growth in their SG&A costs, selling, general, admin, which includes these hiring costs. They expect that growth to slow down starting in Q4. And then revenue growth should start outpacing cost growth again. That shows improving operating leverage.
Makes sense. What about their existing clients, the high-value ones, the partnerships? Any specific programs there to deepen those ties?
Yeah, they highlighted their TBO Platinum program. It's a curated collection of luxury hotels, over 110 properties now, across 40 destinations.
Okay, for premium agents.
Exactly. Gives those agents exclusive content benefits. They maintain over 70% direct share in those specific Platinum hotels. And the share of Platinum hotels in the overall motel GTV mix hit 5.4% in June. So it's gaining traction.
And are they trying to get more business from each agent?
Definitely. They talked about focusing heavily on increasing wallet share within each agency. They're doing that by driving growth in unique active bookers. That number is growing significantly faster than the growth in unique active agents.
So existing agents are booking more often, maybe more types of products.
Precisely. Deeper engagement.
So how does this all look in their monthly transacting buyers number, the MTBs? Are those numbers reflecting this expansion and engagement?
MTBs hit 29,570 in Q1 FY26. That's up 5.2% year over year and 4.1% just from the previous quarter. So growth there.
Okay.
The breakdown is interesting, though. MTBs in India were pretty flat, around 18,486, but international MTBs saw strong growth, up 17.3% year over year.
Big difference between India and international.
Yeah, and they point out that because such a large chunk of their buyers are in India, any flatness there disproportionately drags down the consolidated growth percentage. So the overall 5.2% looks maybe modest, but it hides that strong international growth.
All right, let's pull back the curtain a bit on the operational side. How are their expenses actually trending, especially with all these growth investments happening? And are there other factors hitting their financials or efficiency?
Good question. SG&A expenses, again, that's selling, general admin costs, were 255.4 crore for the quarter. That is up 6.7% from Q4 and 28.8% from Q1 last year.
So costs are definitely rising.
Yes, in absolute terms. But, and this is crucial, as a percentage of revenue, SG&A actually went down. It was 50% of revenue this quarter compared to 54% in Q4 FY25.
So they're spending more but getting more efficient relative to revenue.
Exactly. It suggests improving operating efficiency even while they're investing heavily in growth.
Were there any specific cost lines that jumped out because of these investments or maybe other reasons?
Well, hosting and bandwidth costs saw a really sharp increase, up 94.6% year over year to 40.2 crore.
Wow, nearly doubled. Why?
Primarily because platform traffic more than doubled compared to last year. That's a direct result of more users, more transactions. Plus, they mentioned additional investment in AI infrastructure.
Okay, makes sense if activity doubled.
And importantly, they did manage to cut the infrastructure cost per search by 25%, so they're optimizing, which help offset some of that overall cost jump. Elsewhere, employee benefits were up 25% year over year, business support services up 24%, largely tied to that Salesforce hiring we talked about.
Right, the headcount expansion. Okay, sounds like a lot of moving parts financially. What about things like foreign exchange? Did currency fluctuations impact the bottom line much this quarter?
They reported a net loss from foreign exchange differences of 3.8 crore. That's actually down from 6.9 crore in the previous quarter, Q4.
So less of a hit this time.
Yeah, and they mentioned they've put measures in place to manage FX risk better, more frequent reviews, hedging most of their net exposure. Seems like that's helping.
Okay. And sometimes we see exceptional items in these reports, things outside normal operations. Anything like that this quarter?
Yes, there was. The consolidated results included an exceptional income of 7.7 crore.
Income, okay. From what?
It was a bit of a mix. They recovered about $1 million in bad debts they'd previously written off from a collection agent in Kuwait. That was the positive part. But it was partly offset by a write-off provision they had to make related to GST in their cargo business, so a net positive one-off.
Got it. Okay, finally, the auditors put in an emphasis of matter paragraph in their report. They usually slag something investors should pay attention to. It was about a regulatory issue. Now, for you, the listener, understanding the regulatory environment is always key for global businesses. Can you break down this specific situation for us? What's the issue and what are the potential implications?
Yeah, this is definitely a significant point of uncertainty hanging over the company. The auditor's report points you to Note 4 in the financials. It details this ongoing issue under FEMA, that's the Foreign Exchange Management Act, 1999.
Okay, FEMA, what happened?
Back in May 2022, the Enforcement Directorate, the ED India's Agency for Economic Crimes, searched TBO's premises. This was related to an investigation into alleged money laundering by third parties who were apparently using the TBO portal.
Okay, so third parties, not TBO itself initially.
Right. The key thing is, TBO Tek, its directors, its employees, they weren't charged in the related criminal complaint against those third parties. However, later in September 2023, TBO Tek did receive a show cause notice from the ED.
And what did that notice allege specifically against TBO?
It alleged TBO violated FEMA rules, specifically by letting foreign travel agents book airline tickets and accept payments in Indian rupees, but from parties other than the ones actually receiving the travel services. The notice cited an amount of about 49.37 crore. TBO then did its own internal review and identified the total amount involved in this type of contravention, including other customers, as being closer to 71.225 crore. Now, critically, under Section 13 of FEMA, the maximum penalty can be up to 3 times the amount involved.
3 times?
Yeah.
Okay, that sounds potentially very serious. What's the company doing about it? What's the latest status?
So, TBO Tek filed what's called a compounding application with the Reserve Bank of India, the RBI. Compounding is basically a mechanism to admit you contravened the rule, pay a penalty, and settle the matter without prolonged litigation.
Right, a settlement route.
But it wasn't straightforward. The RBI initially told him to try and regularize the transactions first, get approvals after the fact, or somehow unwind them. Then, on April 7th this year, 2025, the RBI said, nope, we can't accede to your request for post facto approval.
Okay. So what then?
The company refiled the compounding application via their bank in early July 2025, and the bank then refiled it with the RBI towards the end of July. Now, if this compounding application gets accepted, the estimated penalty for the company and two directors is pegged at a much, much smaller 1.616 crore.
Okay. A huge difference between that and 3 times the contravention amount.
Massive difference. But the final outcome, the financial impact, it's all still uncertain. And importantly, they haven't made any provisions or adjustments in these Q1 financial results based on this matter yet. The auditors also noted this uncertainty, but stated their overall opinion on the financials wasn't modified because of it. It's just an unresolved risk factor.
Understood. A significant uncertainty to watch. And quickly, what about the money they raised in their IPO? Are they using those funds as planned for their strategic goals?
As of June 30th, a pretty large chunk of the IPO proceeds, about 253.3 crore, was still unutilized. It's just sitting in fixed deposits temporarily. The IPO, which happened back in Q2 of FY24, raised a lot of money for various things. Tech investments, getting more international users, growth in India, and potentially some acquisitions down the line. So they definitely have the funds, a war chest, if you like, ready for future growth, perhaps once this regulatory cloud clears up a bit. Hashtag tag outro.
What a deep dive. Okay, so summing up, we've seen TBO Tek navigate a really, really complex quarter. They showed impressive revenue and profit growth despite facing those major macroeconomic and geopolitical headwinds we talked about.
Yeah, definitely.
Their strategic pivot, that big shift towards the higher margin hotels plus ancillary segment, seems absolutely crucial. That plus the big investments in sales and getting new agents on board, it looks like it's paying off even while they're juggling rising costs and, of course, that significant ongoing regulatory challenge.
Absolutely. I think their resilience really stands out, that strategic focus on the high margin areas and the fact they kept investing in expansion even when things looked volatile. It points to a clear, adaptable, long-term vision.
So final thought for you, our listeners, as you track the future of travel. Considering TBO Tek's ability to keep growing, stay profitable amidst all these diverse global and domestic storms, what does that tell us about the fundamental strength and, maybe more importantly, the adaptability needed for these big B2B travel platforms today? And how might the eventual resolution of TBO Tek's regulatory situation potentially reshape its path forward?
Definitely something to ponder.
Something to think about as we wrap up today's deep dive.